Good morning, everybody. Thanks so much for joining us today. I'm very excited to be here. I'm Izabella Kaminska. I'm from the Financial Times. I write for a blog called FT Alphaville, which is apparently all about finding the alpha in the system. I'm not sure if we succeed or not, but we try. We're going to be talking about the future of finance for the next hour, and I'm very pleased to say I'm joined by a really esteemed panel of experts. I will quickly introduce everybody, because I think Omar has some slides, but I'll go down this way, and then we'll come to you. So, starting on my right, we have Geoffrey Duncombe, who is Chief Investment Officer of 2 Sigma Advisors. Immediately on my right is Brian Oliver, Head of FICC Sales and Relationship Management at Citadel Securities. On my left, probably needs no introduction, Antony Jenkins, Founder and Executive Chair at 10x Future Technologies, and Omar Sellen, CEO and Founder of Arabesque Partners. And last on my left, Antony Todd, CEO and Founder of Aspect Capital. No doubt they will tell us all about their unique perspective about what's happening in finance, how the disruptors are coming in, and what they are doing to try and allegedly co-opt some of these technologies for their own purpose so as to not lose market share. But I thought I'd start off with Omar, because Omar's got a very unique perspective on the future of finance. It's not just about being edgy with algorithms, it's also about incorporating the sustainability perspective. So, Omar, why don't you start us off with your views on what's going to be important for the powerhouses of tomorrow when it comes to sustainability?
Fantastic. Thank you so much for the introduction. So the way I would love to introduce myself and the concept behind it is, which bank do we think is going to be the largest one in 10 years? Is it going to be Barclays or JP or whoever, or is it perhaps Google, Apple, and Facebook? So I truly believe that this will be something that will be different from what we expect. It will be Google and one of these guys. And I have put together the key points which I feel will disrupt the financial industry as we know it. So basically we have 3 main components. One is the zero interest rate environment. So if we think about this within the 5 asset classes we have, and 50% of the world's money sits in fixed income, is a unique situation that we now have only rising interest rates ahead and negative mark-to-market. So money will inevitably flow to equities. The second point is the availability of large data around non-financial information for corporates and the capacity to process them through machine learning and AI. And the last one is what we like to call the lifestyle feeling of finance, particularly around millennials who try to associate themselves closer with their money. So look at big data. Obviously, that's not a surprise. 90% of the world's data is less than 1 year old. So we're flooded with non-financial information about companies, how they deal with the resources, how they care about their employees, how about the governance structure. And can we find a correlation between a company's performance on non-financial information, on their ESG performance, and the stock price of the company? And while historically we used to think this is like responsible finance and it's a drag on the performance, we strongly believe that there is a positive correlation. And the next main component is the capacity to process big amounts of information. So the concept that a trader would sit and trade based on his gut feel, we think is just over. There's no way that the computer cannot emulate this service just better than any human can. And we at Arabesque built one tool we call the S-ray, which is nothing else but kind of like equivalent to an X-ray for humans. It just analyzes a company's performance on so-called non-financial aspects. So it screens all the publicly available data, but it also screens 50,000 websites in 15 languages and builds a score for these companies in 3 dimensions. One is the UN Global Compact score, so human rights, labor law, and the environment, anti-corruption. There is ESG, which is about the materiality within its sector. And then there's a question of business involvement. So I strongly believe that the next generation of finance will be one very much aligned with the sustainability values of people. You don't have to give up any performance. In fact, I would like to think that sustainability to finance is what electricity is in the car industry. So we have 100 years of perfectly designed engines, but no doubt in 10 years, the majority of the cars outside are going to be electric cars. It's a different type of engines. So I believe also that in finance, the finance in the future will have a different type of engine which uses non-financial information and algorithms that can make a lot of sense out of that and generate alpha. So the one tool I would love to demonstrate, and thank you for allowing me to show this, is on a quick slide or a quick video that we've put together. It just takes a minute, but it'll explain.
Welcome to S-Ray, the first tool of its kind to allow anyone to monitor the sustainability of thousands of the world's largest companies. Through the use of machine learning and big data, S-Ray systematically combines over 200 ESG metrics with analysis from over 50,000 news sources across 15 languages. Each company's extra financial performance is displayed in 3 ways through S-Ray. GC score, an assessment of each company based on the normative principles of the United Nations Global Compact, human rights, labour rights, the environment and anti-corruption. ESG score, a sector-specific analysis of each company's performance on financially material ESG issues. And preferences filter, a unique search tool that allows anyone to check how companies are compatible with their own personal values. We believe that S-Ray can empower all stakeholders to make better day-to-day decisions for a more sustainable future. Transparent, powerful, and available to all. This is S-Ray.
Brilliant. Thank you.
So I think that's a good point to kind of ask you, Antony, about your vision about the future of finance, because you equally, in the little brief conversation we had, implied that you see sort of fourth industrial technological revolution really impacting finance on this front. Do you side with the sustainability factors as well?
I think the most important thing to start a conversation like this is to really understand what's happening with the underlying technologies. Yeah, artificial intelligence isn't a new concept. People were working on AI in the 70s. The difference between then and now is that the amount of computing power you need to be able to manage the data is available at a cost which is affordable. And as the capability of computing goes up and the cost comes down, it opens up the ability to transform quite complex industries like financial services. By the way, it's also true of healthcare, education, professional services, and other areas of our lives. And the reason for this, the reason why this works so well in financial services is because if you think about financial services, it's just data. There is no physical component that has to be moved around. It's just data. And actually, what's really interesting about this increase in computing power is it enables 3 fundamental technologies which are going to transform finance. The first is artificial intelligence, and we saw a very cool application of it just now. The second is distributed ledger technology and all of its manifestations. Everybody will be familiar with cryptocurrencies. We can talk about them if you like. But more importantly, the ability to record the ownership of assets in a distributed, low-cost and secure way means that you can begin to see the elimination of central counterparties. Now, the financial system is predicated on central counterparties. Every payment you make, every security you trade goes through a set of counterparties. Those counterparties add cost and friction into the system, which is bad for the end user, whether that's a corporation or an individual. Anybody who's tried to move money from the UK to the US knows this. Anybody who's tried to make a payment in the UK, when you phone up your bank and say, I want to make a payment, they'll say, well, you can make a faster payment and that'll be free, but if you really want to be sure it goes there today, you have to use chaps and that'll be £25, thank you very much. Well, actually, it's just data. It's the same payment information moving on slightly different rails. So what's going to happen as the computing power goes up into AI, distributed ledger technology, and the Internet of Things, which allows the physical recording of items and their state. You put all those technologies together, you can begin to see a radical re-architecting of financial services. 2 years ago, I gave a speech at Chatham House where I talked about approaching the Uber moments in financial services, by which I meant times in which technology would start to radically transform the industry. I made a prediction then that I thought that something like 50% of people in the industry and 50% of bank branches would close in that time period. It was a pretty punchy set of predictions to make 2 years ago, but actually it looks a bit undercooked today. And this is because of this accelerating rate of change in the underlying technologies. So I believe there's absolutely the potential to create a fairer, more transparent, arguably more secure, cheaper, faster financial system. Very good for the end user, not so good for the incumbents.
So you mentioned the dreaded C word, cryptocurrency, not me. So I think this is a good moment just to bring up its relevance to ESG. So if ESG is really fundamentally about sort of creating an embargo on non-sustainable systems and saying we're not going to deal with that, I would argue that cryptocurrency is the opposite. It is the sort of self-evolving mechanism that allows us to override any ESG frameworks. So if you look at Bitcoin, if you look at all these new sort of innovations coming from that space, they're all focused on the opposite of transparency, the opposite of energy efficiency. Bitcoin especially is exceptionally energy intensive. And this proposition that data is sort of energy-less or has no carbon footprint, I would argue is also perhaps a little sort of simplistic of view, since I remember myself doing a story about how data servers are now one of the biggest growing energy guzzlers out there. How would you square that with your vision?
I think what's going on with crypto is very interesting. I am not, although I will admit I sit on the board of Blockchain, which is the provider of the largest Bitcoin wallet in the world. I mean, what I see in crypto is a very early days of a technology and a capability which has the potential to be hugely transformational. Now, you're absolutely right. It consumes massive amounts of energy to mine, particularly Bitcoins, although some of the other cryptocurrencies are more energy efficient. Those problems will be solved. This conversation is a bit like talking about the internet in 1990. When you talked about the internet in 1990 and people would say, well, you know, you can send an email or you can maybe send a data file or perhaps one day you'll even be able to buy a book on the internet. Most of us would have said, well, yeah, but that doesn't sound very useful because I can buy a book in the bookstore. So we are in the sort of very early days of crypto, and I think that ultimately it is going to be a very powerful force. It is, the issue that you raise, I'm less worried about the energy consumption. I think that problem will be fixed. The more profound issue that you raise is that just like the internet, cryptocurrencies are not controlled by anybody. The internet is not controlled by anybody. The internet is a set of protocols that basically allows machines to talk to each other. Those protocols are specified just as the protocol around blockchain is, but nobody regulates the overall system. Now, some would argue that having a way of transferring value without overall regulation is a good thing. I think that remains to be seen. But for me, that is the bigger issue than the energy consumption, which is a real issue, but I think will ultimately be solved. On the other hand, if you flip it around and you imagine, you know, would the world, if you could fast forward, would the world benefit from one truly universal currency? Of course it would, because it would eliminate massive amounts of friction in international trade in goods and services. But equally, people make a lot of money out of that friction today.
It's a good point to move over to Geoffrey, I think. Geoffrey, I mean, we've been hearing for a long time now about how AI is going to, you know, revolutionize finance. You were just telling me now that in many ways, you guys were way ahead of the curve, telling people, you know, the future is big data, AI systems, systematic trading. This space has got very crowded in the last 2 years. What Antony's saying is exceptionally utopian in vision, but are there risks? What are we not seeing? You guys are, after all, fundamentally all about risk, you know, in the business of risk management.
That's right. So part of the trouble with big data, and it is a very exciting future out there, but part of the problem with big data is that it comes with big noise. And at the same time as we have tremendous amounts of data coming online. And it's true that 90 or 95% of it is less than a year old. The trouble with it is that most of that data is actually useless. It's cat videos and teenagers' text message threads and other things that I think we can agree don't have a tremendous amount of economic value.
Fake news.
There might be some fake news out there. So at the same time as we have all this big data, it's coming with big noise, and that's happening concurrently with the rise of machine learning and tremendous amount of computational resources coming online. And so these new methods that we have of integrating and understanding data in complex, nonlinear, hierarchical ways offer us powerful ways to identify patterns in historical data, often where no real structural relationship in that data exists. So it elevates the big data revolution that comes with big noise, elevates a specific kind of risk, and that's the risk of overfitting. And so specifically, it's about assuming too much in the data, and it's about having such good ways and such powerful ways and such powerful methods to find patterns that those patterns are often spurious. So specifically, overfitting can take 3 different forms. You can develop models based on historical patterns that no longer hold, but once were valid. You can create models based on purely spurious correlations where there is no structural relationship between the variables. And worst of all, you can develop models based on spurious correlation that only look good precisely because everyone is trading that same effect. And so everybody is giving, the players in the market that have identified these patterns through machines are actually giving each other tailwind. And if too many players are out there in the market overfitting their models, it causes the volatility in those models or those strategies to drop. And so they look safer and even more reliable. And then this only resolves in a sort of disorderly regime change that will inevitably be labeled a once in 100 year event or a 20 sigma event or the 1,000-year flood or something like this. So it's definitely a dangerous world out there, and we need to be wearing our risk management hats in addition to buying into the promise of the big data age. And I think there are a couple of common sense prescriptions that we think about all the time at 2 Sigma that hope to get to discuss here. But just to tease those a bit, I think that first you got to hire the right people, and second you have to impose constraints and intuition into the models that you build based on the data. And at 2 Sigma, we spend a tremendous amount of time doing those things.
So before we get onto the talent discussion in earnest, probably worth speaking to Brian here a little bit about how you approach the changes in the market structure coming from not just the technological changes, but how barriers to entry have fallen. So it's been a good opportunity for your business, but do you see it as being simply a technological opportunity, or is there a role to be played by high-touch services going into this disruptive period?
Yeah, so I'll approach that answer from the fixed income markets, where we're now competing in. So just by a quick background, Citadel Securities is one of the largest market makers in the world. We've been around for 15 years, and as a result of some of the changes in both the market structure in fixed income as well as some of the regulatory changes at the end of 2014, many of the barriers to entry came down that allowed a firm like ours to enter the space. So historically, those markets were dominated by the big banks, and in 2014, new entrants were able to come into the market. When we entered the market, we didn't have a lot of the assets that the banks would have: long-standing bank relationships, bilateral documentation. distribution, and we had to differentiate ourselves based on the quality of liquidity that we ended up providing to our end clients. We weren't competing on providing balance sheet or research. It had to be around the quality of liquidity we provided. A lot of that was driven by technology. A lot of that was driven by quantitative resources. A lot of that was driven by our excellence in risk management. And so we were able to provide a live price on a screen for an interest rate swap where no other competitor was doing that. We were able to respond back in sub-milliseconds on large risk transfers where no other institution was doing that. So we were able to leverage technology at the time market structure was changing, at the time regulatory change was happening, to offer a higher quality liquidity to end clients. And ultimately, I think, to join the dots on some of the conversations here, with that market structure change comes the opportunity for different investor types then to start to consider these asset classes as they're traded on the screen, as there's no more bilateral counterparty risk, as it's easier access to that types of liquidity. So the market dynamics in the fixed income, while might be lagging behind equities and FX and some of the other asset classes from this electronification and sort of the so-called future of finance, you can see those trends starting to develop, particularly with firms like ours now entering the space.
But would you say there is still a role for sort of high-touch services in that space? Are customers still seeking that sort of service?
There is, and again, so while when we entered the market as an electronic market maker, it was easier to distribute our liquidity and get access to client flows from an electronic market making perspective. But in the fixed income markets, there are still either large risk transfers that need to take place. There are still more structured transactions that need to take place. There are still a need for that combination of high touch and low touch. And so our business has evolved to now include both a very strong electronic offering where we're performing very well on the screens with clients, but at the same time being able to interact and facilitate large risk transfers that are often and still done, and I think will still be done in more of a high-touch way.
Thank you. So Antony, Todd, your firm has been around for the last 30 years, correct? How are these trends affecting you, and where do you see the future in terms of both risk and opportunity?
Yeah, I mean, I think, so Aspect, I co-founded actually 20 years ago. We're an entirely systematic investment manager, a team of around 130 people, big focus on research and development. Prior to that, I worked as another systematic manager going back even further. I think in terms of some of the opportunities that we actually can see at the moment, I'm very much going to come back to what clients are actually looking for at the moment in their portfolios. And I think, speaking to institutions worldwide, it's clear that institutions are faced with a significant challenge in their portfolios. Last 35 years, for the majority of institutions, it's been relatively straightforward. There have been significant tailwinds in terms of declining inflation, declining interest rates, increasing productivity, global growth, emergence of China, which have driven remarkable bull markets in both fixed income markets and in stock markets. And I think the risk that investors face today is that the next 10 years, next 20 years, are going to be very different from the last 35. So what are investors looking for now? Investors that we speak to are looking for two forms of performance stream. One, they're looking for performance characteristics that will be uncorrelated with stock markets, uncorrelated with bond markets, particularly if we were to see a significant downturn in stocks and bonds. The other type of performance profile we're finding clients looking for is they're looking for a steady source of return. Where can I find, over the course of the last 35 years, it's been easy to generate LIBOR plus 500, LIBOR plus 600, LIBOR plus 700. You just needed a very evenly balanced portfolio of stocks and bonds. Where can I find that now over the course of the next 10 or 15 years, potentially in much more multi-strategy type programs? So from a technology standpoint, I mean, I think actually that's exactly where technology can play a very important role. Insofar as quantitative firms, systematic firms, have the ability to be able to customize solutions for clients far more easily than traditional long-only managers. So clients coming to us, if they want a particular level of target vol, they want a cap beta program, they want a combination of different investment styles to generate either those uncorrelated returns or that steady source of return, I think many quantitative firms are well placed to be able to provide those solutions. Sitting in a long-only traditional discretionary kind of fund manager, I think it's far more difficult to be able to construct those portfolios and those return streams.
In our upcoming sort of, steady return and uncorrelated future, where are the risks? I mean, some of the products that are coming to the space to compete with the more traditional offerings are very low cost. They're ETFs, active ETFs. Where would you say are the risks, if any, especially as the competition heats up?
Sure. I mean, I think two very, very, very kind of key risks that we actually can see. In our sector, one of the investment programs that we run is something called medium-term trend following. So with the aim of capitalizing on trends over a period of 2 to 3 months in global markets, in stock markets, bond markets, currency markets, and commodity markets. Now, what we've actually kind of seen again with the impact of technology over the course of the last few years is increasingly barriers to entry for running risk premium type strategies have come right down. And so we've actually seen in our sector the emergence of a large number of very low-cost, medium-term trend followers and risk premium providers. That to me is risk number one. Our view is that markets are constantly evolving, the space in which we operate is massively competitive, and therefore the performance stream of any of these risk premia will get eroded over time. The way to actually counter that performance erosion is through an active process of research and development to refine, improve, add to the models. So a lot of the programs we're actually seeing today in the risk premium space, they cost tens of basis points. Effectively, you get what you pay for. There is no research content of any sort whatsoever. They're pure fire and forget, static, rules-based. Our view is that those static, rules-based risk premium strategies, that is risk number one. They've been over-optimized, significantly kind of curve-fitted, no research. They will generate disappointing returns. I think the other risk I'd actually can point to is liquidity mismatch. In the markets that we trade, the majority of the programs that we run, we offer daily liquidity to our end investors. Therefore, we're trading the most liquid futures markets, currency markets, non-deliverable forwards, sector swaps, credit default swap indices, interest rate swaps, but a real focus on highly liquid markets. In the ETFs that we trade, we're highly kind of cautious because what we can actually kind of see there is many investors have just forgotten the lessons of the 2008 collapse, where suddenly in 2008 there was this mad rush for the door, mad dash for liquidity, and investors suddenly found that many of the instruments they'd invested in, simply the door was locked. They simply could not actually find that liquidity that they'd been promised. Many of the ETFs that we look at, I would say particularly in the higher yielding space, in the credit space, offer this illusion of liquidity, but underneath that illusion of daily liquidity sit a number of potentially, in a crisis situation, potentially illiquid instruments. So that's the second risk, that potential liquidity mismatch.
Liquidity mismatch, for me, is a key sort of side effect of all these sort of whizzy technological systems. I was just wondering, though, Antony, do you think things like DLT or blockchain technologies can provide solutions? I mean, you mentioned this idea that having a single currency might solve a lot of problems in terms of cross-border frictions and payments. But my fear would be that these frictions exist for socio-political reasons, not necessarily just for pure financial kind of technical reasons. How would you square that? And if the real problems are socio-political, can things like DLT really resolve these risks? And can they also resolve the liquidity issue?
Well, the liquidity issue, like any liquidity issue, is a product of how many buyers and sellers there are at any point in time. That's a sort of human thing. Mm-hmm.
But I would argue DLT is aspiring to create the illusion that DLT will create an immediate payments squaring system that never runs into any bottlenecks and doesn't have any mismatches on supply and demand.
They're two separate things, really. I think firstly, whenever we have these conversations about technology, it's very possible to get starstruck by the tech. At the end of the day, this is all about people. Yeah, people getting stuff done. People are optimists and pessimists. People are good and people are bad. People work for the greater good, some people work for their own good. Those human dynamics are never going to change. And what we've seen with every type of technology that's ever been deployed, from the wheel to the PC, is that it's used for great good and it's used for great evil. We're not going to change human behavior with technology, but what we are going to be able to do is allow humans to get some stuff done faster and to squeeze out inefficiency from the system. Now, asset management is not my area of expertise, but for any investor, there is a lot of cost in going through an asset management vehicle. Generally speaking, if those costs get squeezed out, returns go up for the end user, the investor. That's got to be a good thing. But your bigger point, I think, about the socio-political consequences of this, that is absolutely real. And we've seen that with every other technology that's gained currency in the last 20 years. What is the effect of Amazon on the local bookstore? What is the effect of Facebook on the fake news industry? What is the effect of all of those systems on media, truth, veracity, those types of things? There are always second order and unintended consequences. And the difficulty with technology is it becomes much harder to control and police these systems. So I am an optimist about this. I think the net will be positive. I think we will definitely see transaction costs come down. I think we will see greater transparency and fairness. I think that will benefit end users, whether that's an investor, a company, an individual. As I said before, I think it's not good for the incumbents because they make money out of that. But there is a whole set of second-order questions that have to be answered. In this new world, identity, privacy, security, data ownership, all of these things become incredibly important. For any of you who've used a contactless credit card today, who does the data around that transaction belong to? Is it your data because you were the person who took the tube or cab journey? Is it the tube or cab providers? Is it the banks that sit on either end of that transaction? Is it Visa or MasterCard that connect the banks together? Is it everybody's information or nobody's information? And the reason why that's important is because until you can define data ownership, you can't define the rules around data, who has permissions to use that data, and crucially, how does that data get monetized? And this is going to be a big battleground in the coming years as people seek to make money out of data, individuals increasingly become aware of the value of their data and want to control the monetization of it themselves, and governments and other organizations want to impose order on systems which are very, very difficult to control, as I mentioned before.
I'm glad you mentioned data, because I'd like to put the following question to all of you, really, which is that I think traditionally banks and financial institutions have treated data as a liability, in so much as, from their perspective, if you're a bank and you accidentally release all your clients' information, that's a big no-no. Banks are secret keepers by and large. Technology companies have moved into this space, and they, to the contrary, see data as an asset. And we're pricing a lot of these big technological disruptors based on their data sets, their legacy data sets. With regulation coming into play, especially here in Europe, the GDPR new rules around exactly what we were talking about, who owns the data and the risks of that data leaking. How will many of these models be affected, given they come from the tech space, which views data as an asset, not as a liability? And if we've been creating this fintech disruption around the perception that data is always going to be an asset, not a liability, is there a risk there? So any of you have any views on that?
Well, let me just make a couple of points building off what I said before. Data is overwhelmingly an asset because in a sense it is the truth. The issue for most existing financial institutions is they can't even find the data, let alone run any machine learning or big data on it. 4,000, 5,000 different applications, similar numbers of databases across banks, the same data element recording thousands of times, simple things like name and address. Very, very hard to run those applications. So banks have sat on a lot of data, but their ability to do something with it is quite limited. Now, imagine a world in which the capabilities that we've been discussing allow much more accurate decision-making. I won't talk about whether this leads ultimately to the elimination of alpha, but because that's not really my area of expertise. Let's take a simple example, credit scoring. The thing that makes credit scoring difficult is false positives. Yeah, so you lend money to somebody you shouldn't, or you don't lend money to somebody you should. That's basically how credit scoring, that's the problem with credit scoring. And because that is an imperfect process, banks in the mortgage industry and credit cards, unsecured lending, build in a percentage of loans as losses. And there's a whole accounting methodology around that. Now, if you were able to reduce those false positives, what that would mean is that better credit risks would get lower cost and greater amounts of credit. But worse credit risks would get less or no credit or more expensive credit. So in this new world, data becomes a way in which you get to the truth, but that truth is going to have some profound consequences for individuals. If you look at the bottom 20% of society that has almost no access to traditional forms of credit through the banking system, it's possible that that could open up credit for some proportion of that population. On the other hand, it means that a lot of people are going to get smaller or no mortgages than they used to. So this question of data is a really profound one. I don't think, again, we're going to see a lot of that transformation coming from the core incumbents, though.
I mean, for me, what you're saying is that the future is going to be a highly there's going to be a lot of stratification in our society as a result of this. You're going to have essentially blacklisted communities who can't get any credit or access to financial products or even assets, and then you're going to have a bunch of people who are limited based on their behavioral legacy behaviors. And then you'll have some pool of really rich people who can pay their way through any risk. That doesn't sound all that great to me. That sounds like the opposite of democratization and all the sort of hype that was hearing from...
No, I don't think that's... If you think about what I actually said, what I said was that this could open up credit to lots of people who can't get it today because the data is imperfect. But it will also limit the application of credit to people who are getting it today when they shouldn't or are getting too much today, which is actually a good thing for them. But you're right about your stratification point, because obviously data allows you to make more precise decisions, and when you have more precise decisions, you end up with greater stratification. But overall, the outcomes of that, I think, can be a net positive. And actually, we've seen this in places in the world where there are there's no traditional banking system for large parts of the population. If you look at what's happened with M-Pesa in Kenya, for example, that basic payment capability has allowed small amounts of lending to be built on top of it and has a very beneficial effect on economic growth.
But it has also facilitated a lot of crime. And again, these unintended consequences keep coming up. So, we've not had this proposition that digital currencies are going to remove risk and all that stuff. Actually, what we've seen with increasing electronification of the financial markets is greater access to, effectively criminals taking advantage of these virtual systems without having to do face-to-face crime, which is much easier. But I would like to expand and bring in some of the other people on the panel. You mentioned human talent. Where does this, are you in some way shooting yourselves in the foot? Isn't the point of finance essentially not just to cultivate talent in your own sector, but also to inspire, effectively allocate capital in a way that creates jobs and doesn't dispossess people of their livelihoods?
Yeah, absolutely. I think that one of the traps we can get into is by falling in love with computerization and automation, that we forget the value that human beings can add to the process. And so at 2 Sigma, we have been steadily adding headcount, even as we have been steadily, maybe even exponentially adding compute power. We think that hiring more and more people to to work alongside the computers makes the process stronger. So I think that there's a little bit too much hype around what the machines can do without any context. So many of you in the room probably have technical degrees, or you have, you've written code and your machines are working for you. And to you, I guess I say congratulations. It's probably going well. To many of you, the others of you who don't have technical degrees, I also have good news. So I think that not only will people remain relevant, especially people with financial skills, financial professionals remain relevant, but the premium for sound judgment and hard-won expertise will continue to increase as we automate more and more of our processes within finance. So data science done well requires two things. It requires domain expertise, domain knowledge, and also passion for its application. So first, take domain knowledge. The skill set of the candidates that we see at 2 Sigma is increasing every year. So undergrads in our interview process now arrive with the same skills that PhDs did a few years ago, and that's really impressive. But the ones who really succeed, the ones who really excel, are the ones who can answer contextual questions about data. They know how to apply their technical skills to the thing that they're modeling. So they can answer questions like, when would you use this tool? And when would you not? When would you expect it to fail? How would you sample this data set to prevent overfitting? So the why is often as important as the how. Second, take passion for the work. So it's a truism that passion will motivate deeper learning, pun intended, or excellence within a domain. So nowadays, it's become extremely competitive to land top talent in data science and machine learning. But what we try to do at 2 Sigma is to try to find the people who are truly fascinated by financial markets, by capital allocation, and what that means, rather than just the data scientists who are sort of eager to apply their skills to whatever's hot at the moment. And don't get me wrong, we love the data scientists who have come to finance. After all, 2/3 of our staff of 1,200 come from outside the financial world. But don't forget the finance professionals who have taught themselves data science either, because they're often the most efficient of all. And I would add one last point, and that is that if machines suffer from short-term memory loss in the form of limited data, an experienced human being who has lived through crises, who has managed through difficult times, who has context for the kinds of problems that they're modeling, they're an invaluable commodity. And so we think that adding human capital to contextualize the problems in the world alongside of the compute power is going to make the future brighter.
Certainly humans have empathy, and in a crisis, I recall from 2008, many traders telling me that they were saved by the capacity to just pick up the phone and pull in a favor from somebody, which I don't know whether computers could necessarily do as effectively. But on the, Omar, coming back to the ESG front, is it fair to argue that if that's the future of finance, it's a relatively privileged perspective on the world? Because ESG, we all want to be sustainable, but some of us in the world can't afford to be sustainable. So is the vision you're outlining very specifically one for essentially a developed market that can afford to say no to, dirty products or, the alternative?
Right, perhaps quite the opposite. So, to me, sustainable finance or the future of finance has 2 components. One is the whole data and machine learning and AI and all the things that Jeff said and Antony, and I very much agree with that. So let's not take away from that. But there's a second component which is equally as important, which is the data will allow you to actually build some transparency, some knowledge, some understanding of your money. You can start developing what I would like to call a lifestyle feeling of finance. So let me give you a simple example. There's this beautiful case of Dr. Brown. She's a leading oncologist in Australia. And for 20 years, she was working in a hospital, curing the issues of cancer as a result of smoking. Mm-hmm. And then she was asked to join the pension board of her hospital, and she looked into it, and she found the majority of her positions were tobacco companies. She said, how come that I spend all my life fighting the causes of smoking, and my money does exactly the opposite? And ESG, or sustainable finance, goes way beyond just industry exclusion. But it shows you one simple thing, that money is an incredibly powerful tool to express your values. Now, I ask all of you in the audience, think about a moment, if you truly know today what your pension, what your savings, what your money is doing. Are you funding, tobacco, weapons, alcohol, gambling, adult entertainment? Are you involved in companies that commit issues on human rights, on labor law, that supports child trafficking and all these things? The truth is we just do not know. And through data and through AI, we actually now can start to understand what our money is doing. And we all have values. We don't have to have the same values, but we all as humans have values. And what it actually will do, which I believe sustainable finance becomes an incredibly powerful tool, is once it becomes a mainstream thing. Once it's not just a question of rich families or institutions that can afford that, but exactly your point, you can take it into the mainstream. You can allow people with little money to express their values through their money. And that to me is a very important point, and almost as important, if not more important, than the whole big data and AI conversation.
But isn't there a paradox here, in so much as people who have very little money are always going to spend it on their immediate needs?
Yep.
And when those immediate needs are water,
Yep.
shelter, et cetera, they will take the lowest price,
Right.
irrespective of whether it's come from a sustainable source or not, because they have to feed their families. So again, I propose, are you looking at it from a slightly overprivileged perspective?
I don't.
Because the people who are putting that money to work to make these decisions are those with the money, and their political and sociological outlook might be very different to that of the people without the money.
Yeah, so I'll give a very short answer. And there's two components to that. Number one is the supply chain, so the people who are involved as employees, as consumers, and so on. So we look at a telephone like a new iPhone, and we say, wow, that's such a great tool and an instrument of democracy. But the truth is, we don't care. We don't understand that people are suffering in China and Indonesia in the production. The guys who bring us the rare earth in Africa to make this thing happen have incredibly poor circumstances. In fact, if I just buy some chocolate from Marks & Spencer, I do not know about the supply chain, the guy who actually brought me the cacao from Ghana, how he did so. So what sustainability first and foremostly will do is to bring you transparency. As an investor, you now can say, I will not invest in this company because it doesn't treat people well, or it doesn't have a good policy on women empowerment and other things. So that thing will surely help the community. And the second thing is then obviously on the savings side, on the investing side. If you have transparency, if you can find a correlation between a company's performance on the stock price and its sustainability, then it becomes a positive thing. We just have to eradicate from our minds that responsible, sustainable investing costs you money. It does not. It's a smarter way of investing. It will generate more returns. It's a great risk management tool.
We've got 4 minutes left, and I just thought maybe to open the panel to questions from the floor very quickly. We've probably got room for 2 or 3 questions at most. I'll take them in a bundle. So one here. There's 2 microphones going out. So one here. Anyone else here at the front? And I'll take one more. And please keep them short because we've only got 3 minutes 45.
Hi, Paul Davis. I'm a financial columnist at the Wall Street Journal. So there's a paper a couple of years ago from a guy called Philip on the productivity in finance over the last 100 years or so, and discovered that it had barely changed at all throughout all the technological innovations that we've had and so on. And my question is, with all the stuff that you're doing, and particularly to Jeff and Brian, squashing transaction costs, taking out frictions and so on, are we finally on the verge of seeing productivity improve, or will the industry continue to find ways to insert itself create new frictions and protect its sort of revenue pools?
Let's take the other question very quickly, and then we'll answer.
Universal income might be the thing of the future, and that would change the finance, I think, if it happens. What are your thoughts?
Okay, so
Brian, you want to take that one?
Yeah, I'd rather answer that question than that.
go for it.
So, I'll speak from our firm's experience. So, if you look at what we've been able to accomplish in the fixed income markets, where we're a leading provider of dollar swap liquidity, a large U.S. Treasuries market maker, Euro swaps, FX, et cetera, and I look at the team that we have to do that and compete in those markets, certainly the change that's happened that's allowed us to do that has certainly increased our productivity. So the comparable team that historically would have done that at a incumbent provider is much larger than we have today. And a lot of that is because of the market structure change, technology change, data, information, all the things we've talked about. So I do see, at least in the fixed income markets, productivity increasing and being able to get more from less, but still provide a higher quality of service than what was being provided in a much larger, less productive organization.
Thank you. And who has 1 minute, 40 seconds to reply to the universal basic income question? Who would like to take that challenge? Come on.
I already said no.
So I'll give you a quick
Yep.
sort of 30 seconds on this. So we've talked a lot about this technology change in financial services, but the truth of the matter is digital technologies and other technologies are pervading all of our societies and economies. I do believe that we are sort of at a fork in the road. We can either choose to embrace these technologies and make them work for everybody in our society, or we can go down the road of increasing inequality, reduction in social mobility, and an exacerbation of the trends we've seen in the last 20 years. What's going to make the difference? There's a very few policy levers that can be pulled. One is around skilling and education, a very overhyped topic, but actually it is true that unless you give people the skills to be economically productive in a very changing economy, you're not going to have reductions in inequality. Secondarily, infrastructure becomes incredibly important. And thirdly, regulation and legislation. But to your point about universal basic income, although it is an anathema, I think, to many who have grown up in the capitalist system, I do think that there are policy actions that we will need to consider in a very different economy over the coming years. And I would not personally want to rule that out in some form. But we have to address this problem and opportunity on many fronts if we're to be successful. And by the way, back to your point about sustainability, it's exactly the same. Business has an interest, a big interest in making this work, because if you have growing economies, you have people who can buy your goods and services.
Thank you. With 2 seconds to go, the algorithms won't go crazy. We've done it. Yes, fantastic. Thank you very much. We are truly in line. Okay.